It's been 5 weeks since my last video. Back then, President Trump had already announced a 90-day delay on the imposition of most of his proposed tariffs on other countries' exports, leaving a 10% tariff in place pretty much across the board, but with one giant exception. Tariffs on Chinese goods were still effectively 145%, a rate that even Trump's own Treasury Secretary said was uneconomical. We've now had another major climb down. The US has suspended most of those sky-high tariffs on Chinese goods for 90 days. All tariffs imposed before the 2nd of April still apply, but that means the effective tariff rate goes from 145% to 30%. Financial markets have responded positively, confidence has returned, and while uncertainty remains, the path forward is a little clearer. To be sure, this may not mark the end of market swings, but it clearly shows how powerful policy clarity, even partial clarity, can be. So let's talk about how the investment outlook may have changed and, more importantly, what it means for you. First, I'm sure you're thinking, will this truce stick, right? As with all recent White House policies, it's difficult to say anything about the future with all that much certainty, but they did dress this up as a win, and both the US and China spoke relatively highly of each other. The White House also praised China for bringing a minister to discuss fentanyl-related issues too, suggesting there could be more good news to come on the 20% tariff that remains in place that was imposed as punishment for not policing illicit fentanyl exports. Now, we don't try and second-guess President Trump, but we do have a working assumption, and that's that tariffs on other nations' exports mostly settle around 10%, with some higher sectoral tariffs and China's tariffs remaining slightly higher too. The economic impact of this truce, while positive, is nuanced. Before the rollback, tariffs could have added up to 2 percentage points to US inflation, although more likely closer to 1 percentage point. If the truce holds, the inflationary hit is now more likely to be between 0.5 and 1 percentage points. That's the impact of firms partially passing on tariff costs to consumers. So-called second-round effects, for example, the knock-on impact on wages and then looping back again into prices, they're harder to judge, but probably haven't receded as much as the direct effects. Survey measures of consumers' inflation expectations have risen sharply, which is actually quite rare when actual inflation hasn't spiked. And Americans may be so psychologically scarred by the last few years of high inflation that they drive harder bargains with their employers. A recession is now less likely, however, and so the risks to employment have fallen by more than the risks to inflation. Yet again, US inflation is a key risk to both equity and bond markets this year. Now, in contrast, inflationary pressures here in the UK are set to ease due to a stronger pound, cheaper goods from producers abroad no longer selling as much to the US, lower energy prices, and weaker global activity, although not by as much as we assumed before the White House's latest climb down. Turning back to the US, the direct impact of the tariffs on US economic growth will be smaller than before this truce was agreed. But remember, as we discussed last time, some of that hit comes from heightened uncertainty and its impact on business investment and hiring plans, and uncertainty has not completely gone away. We're revising our estimate of a US recession coming in the next 12 months down to around 1/3. That's down from 45% previously. Ultimately, the most likely outcome still appears to be a significant slowdown in US growth, but not a recession, perhaps up to somewhere in the region of 1% growth for 2025. It's worth noting that counteracting the tax-like impact of tariffs, a highly stimulatory tax bill is progressing through Congress at the moment, although we don't yet know the extent of any offsetting cuts to government spending. Now, the rebound in equities has been rapid. All major geographic regions have now posted a positive total return since Liberation Day, when the all-encompassing tariffs were first revealed. This may be too rapid for comfort for some investors, but it's worth pointing out a couple of things here. First, the trade war has played out during earnings season, and that's when US companies report their earnings from January to March. We shouldn't overlook that it's been a really rather good one. Aggregate US market earnings per share grew 12% year on year in the first quarter, and that's double the consensus expectations for 6% growth made at the beginning of the season. Sure, it's a bit rearview mirror, and the trade uncertainty meant that most companies maintained prior guidance for the rest of the year ahead, when historically most companies raise it when Q1 results are released. But still, it's a strong start that gives more leeway for earnings later in the year to come down. Second, the rapid recovery in equity markets is a reminder of why investors must have a process, one that's grounded empirically in how markets behave. Now, as I often explain, when equities hit a speed bump and markets fall by 10% or more, investors must assess for signs of systemic stress, that's banking stress, debt market stress, or the odds of an economic or corporate earnings recession becoming more likely than not. If nothing is flashing red, investors should stay invested because the recovery can be very rapid indeed, especially when it's driven by events exogenous to the business cycle, such as populist politics. And let's take a step back and consider this. We've had 7.5 years of rising trade tensions, a pandemic, an energy shock and the permanent remapping of the world's energy supply, and an inflationary episode not seen since the 1970s. And yet global equities have more than doubled over that period. Corrections happen. We've had 4 of them. They are often without warning, sometimes driven by politics, but the long-term picture is usually okay. Why? Because markets ultimately price the future earnings power of real companies solving real problems. And today, global supply chains are adapting, AI investment continues to accelerate, fiscal support remains strong around the world. Yes, for sure, there are headwinds. US margins may come under pressure as a result of tariffs, inflation will rise again, government deficits are pushing up borrowing costs, and the equity market tailwind from the technology sector isn't what it was. But this is precisely why we diversify, why we rebalance, and why we take risk only where we believe the long-term reward justifies it. The rapid recovery does mean that the spread of possible outcomes over the next 6 months is somewhat asymmetric. The downside if trade tensions re-escalate is larger than the upside if de-escalation continues. Our core investment philosophy, which looks for high-quality, high-profitability stocks that have a track record of delivering peer-beating return on capital, is something that the evidence suggests does particularly well when growth is slowing and when uncertainty is high. It helps us to address that asymmetry. We're not chasing momentum, but we are staying invested. We're not predicting recession, but we are preparing for volatility, and we're not buying into fear. We're managing risk actively and with discipline. We'll be watching for 3 key things. Trade relations, of course. Will the US-China deal last beyond 90 days? What about a deal with the EU? We'll be watching the Federal Reserve. Are they done cutting if price stability is now in question? Chair Powell has hinted at this recently. How will the market digest this? And we'll be looking at earnings and margins. Corporate America is doing well, as I said, but the next few quarters will be crucial for understanding the pressure points, particularly in technology, industrials, and consumer-facing sectors. I'll update you again in my next video in June. Most importantly, we remain focused on your long-term financial well-being. That means not reacting to headlines without conducting deep analysis, not panicking at volatility, and not chasing short-term facts. It means sticking to a plan, sticking to a process. I'm Edward Smith, Co-Chief Investment Officer of Rathbones Investment Management. Thanks for listening.